Hello, and welcome to the Power of Passive Investing webinar series. We have a very interesting guest today. He's a real estate investor, and like many of us, he started in residential real estate and then later switched to commercial. But why don't we ask him to share his stories? Nikita, welcome, and please share with our audience a little bit about you.
Thank you, Elena, for having me here. As you've mentioned, my name is Nikita Zhitov. I live in Raleigh, North Carolina. Have lived here for 25 years. Have been doing commercial real estate for 21 out of those 25 years. I've started at a very young age, pretty much my senior year in college, my senior year in high school, freshman in college is when I started doing my first deals and pretty much have been doing full-time real estate investing ever since. Started out in residential and multifamily, as a lot of people do, and then eventually transitioned to commercial, and have done everything from development to all asset types. Yeah, so it's been a pretty long ride, a fun ride along the way. Hasn't been a smooth ride, so had a few bumps along the way, but that's what makes it fun.
That's what makes it fun, and that's what makes it a real business. Real estate, just like anything else, is a real business. And if you were to tell me that everything was going well, then I would probably not believe you. But yes, bumps are completely expected, but bumps are usually the lessons that we learn from. And it's always easier to learn from your own lessons than from someone else's,
Yeah.
for sure.
Yeah, well, it's easier to learn from others' lessons, but sometimes they don't hit home as
Ex-
much as your own lessons, right?
Yes, very true. Yes, you're absolutely correct, Nikita. Yeah. Interesting story. And I feel like you've been very, very modest in terms of what you shared. You said that you started in high school. Did you go to college or did you go directly into real estate? Skipping.
I went to college for a short period of time. I actually had a full ride. I had to go to university, but I by the end of my first semester, I already caught the real estate bug. So I became obsessed with the sport of real estate investing and creative finance and acquisitions of investment real estate. So I dropped out from college, walked away from scholarship to pursue life and career and passion in real estate full time.
Amazing. Wow, that's impressive. So you sound one of those famous college dropouts with a full ride that went and found something else, and it definitely shows that real estate is your passion. So when you started out, Nikita, you were flipping homes. How did you get to the point where you decided to switch from residential to commercial, and what kind of commercial did you switch to?
Yeah, so I started again. I was obsessed about all types of real estate. So I didn't specifically started out flipping homes. Actually, my very first deal was multifamily apartment building, 16 units. That was my first deal. And then I primarily focused on buying multifamily apartments. Along the way, I've heard about this thing called flipping homes that you can make some short-term gains. And so I, tried a little bit of that, but uh, I've started out in multifamily and commercial pretty much right out of the gate. Again, I've done residential flips along the way, but it hasn't been the primary business of focus. Um, when I made the switch from multifamily or residential real estate, so to say, into the full-time commercial, it was probably after the 2008 recession. I think it probably was like 2010, 11 when I made the full-time switch. And primarily because uh, residential, it's you're dealing with full service leases or gross leases where, first of all, the leases are short term in nature. Um, and if something breaks, it's usually your responsibility. You know,
Yep.
say kind of a similar to office buildings. Office buildings are also gross and full service leases where you're responsible for, janitorial service, you're responsible for elevator maintenance and, common utilities, all of that stuff. So as I used to manage things myself, now if you get into Class A multifamily and you hire professional property management companies, I guess the management headaches don't bother you as much because you have a full-time professional property management handling those things for you. But again, I was starting out dealing is primarily in Class C and B multifamily and smaller buildings, not Class A institutional assets. So a lot of the work I was doing myself. So just for the quality of life and for time management purposes, I thought I would be better off focusing on retail or industrial or other type of commercial assets that had good triple net leases, lease structure, where the tenant would be responsible for ongoing maintenance and things like that. So
Sure.
it was more for selfish reasons, I guess maybe because of I was lazy and I didn't want to deal with. I wanted to work less and not
Good
more.
lazy. Yeah, no,
So
smart.
yes, I wanted to work smarter and not harder. So that was kind of the reason I decided to focus on commercial and shift away from multifamily and residential.
And that was around 2011, you said, when you made the switch?
Yeah, I did few commercial deals before that time, but really I went full time into commercial probably after 2010, 11, which keep in mind that was right after the recession. So for probably 2 or 3 years between 2010 to 2013, I haven't really done a lot of transactions at all. I was kind of just doing brokerage. And then when I started investing again, 2013, I got into development business, started developing, building ground up. It's pretty much been commercial. I mean, I've developed a few multifamily projects since that time, but probably for the last 10 years for sure, I have been focused exclusively on industrial and retail.
Interesting. And in terms of the geographic location, where have you focused for the most part?
Primarily being close to my home, which is in Raleigh, North Carolina, throughout North Carolina, but properties in Charlotte, Triad, in the Carolinas. Right now I'm doing some deals in South Carolina, but over my 20 plus year career, it's been historically close to my home just because I understand the local market, I know the local market. My investors who invest in projects with me also understand the local market, and they kind of, because we syndicated all deal by deal historically, investors kind of follow the product, they like the deal, they invest in it. Moving forward, we actually currently reorganizing our company as a fund, where we would be scaling across Southeast. So, and as we're going to be dealing with different type of investors that are more institutional type of investors, that they would have a comfort level to go to different markets, because local guys who we historically have done deals with, they only wanted to do deals locally. So us not scaling outside of our market has been driven by two factors. One, just our knowledge of the market.
Of course.
Comfortable with the local market. We were not comfortable with other markets, and also our investors. They wanted to, while they followed us, they didn't feel as comfortable going outside the market. But again, we are transitioning to different type of investors. We're transitioning to different type of how we structure and operate. So now I think we're ready to scale throughout multiple states.
Got it. That's excellent to hear. So let's unpack a few things that you mentioned. You mentioned that you're planning to build a fund. Will you focus on specific asset classes, or will it be most of the triple nets?
It's going to be primarily focused on small bay industrial as a buy box. So that's where we see the biggest margin and opportunity to create a lift, a light lift. While having the largest profit margins on the rent spreads between what historically small bay hasn't been in a sexy asset class, and a lot of product hasn't been built, at least in the markets where we operate in. We see a lot of the same owners who had it for 20, 30 years, and they haven't just escalated the rents the same as the other asset classes have escalated the rents over the last 20 years. So we see a lot of small bay industrial stuff renting $6, $8, $10 gross rents. So we're in the market. And if you look at the replacement cost, you cannot really replace that type of product type for less than 250 a foot after we factor in the cost of land and engineering and soft costs and permitting and everything factored in. You're looking at 250 a foot all in by the time you're done. So you really cannot rent it for less than like 18-20 bucks a square foot and for it to make sense. And so if you can buy existing product that's rented at 6, 8, 10 bucks gross, and you convert the leases to triple net, maybe do some cosmetic renovations, convert the leases to triple net, bring them up to market, maybe 14, 16, 18 bucks triple net, you can double the value in like 6 months instead of doing new development that's going to take you 2 years to get permits and a year to build and a year to stabilize. You're looking at 4 or 5 years before you really can realize your gains on a new development. So if you can buy existing inventory and it was just some cosmetic light lift, turn the property around and double or triple the value in under a year. That's we just found that to be the best business model. And the same goes with neighborhood retail. So that's our secondary asset class that we're targeting. The primary is small bay warehousing as a backup asset type would be neighborhood retail. Same business model.
Yeah, got it. Sorry for the interruption. When you say small neighborhood retail, so you're not looking at something that has big box anchor, only a small mom and pop.
Yeah. So again, we've done big box retail. I just closed on probably one of the largest properties we've ever closed on just months ago.
Congratulations.
Big Kmart box that we're redeveloping here in Raleigh. But you see when you have a big box tenant go vacant, there may be only 50 tenants in this country who can backfill it.
Mm-hmm.
And they're gonna pay you cheap rent. They're gonna ask for a year of free rent. They're gonna ask you a bunch of TI, and really economics don't work the same way as on a neighborhood retail inline spaces. When I have a 2,000 or 3,000 square feet user, I go vacant in a neighborhood retail center, I can backfill it with about 3,000 other users. Your nail salon, your vape shop, your barber, your real estate office, tattoo salon. There is about 3,000 type of different users who can backfill it with minimum rent abatement, minimum TI, just white box it, cosmetic, and 2-3 months later you are fully leased again.
Sure.
So it's more of a risk aversion strategy than growth strategy, but it just works out that where we see a lot of profit margin and a lot of discrepancy between what landlords charge for rent versus what the market can support. It just happened that in the neighborhood retail, you're also dealing with less sophisticated sellers and less sophisticated tenants, and there is bigger arbitrage opportunity to bring the rents to market.
Sure. So nevertheless, despite the strategy you decided to buy the retail with the big box, was it because it was local to you, that where Kmart used to be?
So yeah, it was the way it started out. Actually, we were gonna convert it to small bay industrial. We're gonna take a big box and chop it up into like 46 small industrial bays. So going into it, we decided that was the plan, to stick to our game plan. And as we started working on it throughout the contract, we just thought, it's just too of a prime of a site to convert it to like a flex property, right, on a prime corner like that of a highway. So it's not just about making money. We wanted to do something that's actually would create a destination and people would enjoy coming to. So we decided we're going to keep it retail, and then when we keep it in retail, we thought that we started getting a lot of inquiries on it and users wanting to lease the space, all kind of entertainment and hospitality users. We said like we can really create like a destination hub with a bunch of entertainment and hospitality uses, So that's why the decision has been made to A, keep it retail, and B, renovate it as a mid-size boxes for entertainment users. And then the long range plan would be to redevelop the property because it can support high density mixed use type of development. But right now it's not a good time to develop. So we just wanted to stabilize things and kind of treat it as a covered land play. So right now we're just renovating that big box into multiple smaller mid-size boxes. And then when it's stabilized, we're probably going to land bank it for 10 years. And then during that period of time, we're slowly going to work on plans to redevelop the site into high density multifamily and mixed use retail and hospitality and office, in multiple phases over a period of time.
Interesting. So a couple of questions on this project, Nikita. Was this a standalone Kmart building? Nothing attached. Got it. That
Yeah,
makes sense.
standalone building, 120,000 square feet on 12 acres.
Excellent.
Wells
Wow.
Fargo is an odd parcel, and Wells Fargo, we are, it's just going to be a part of overall redevelopment.
Are you keeping the safe? A lot of people asking, like, when it's a bank, are you going to keep the safe? Usually they have.
I don't know if it has a safe. I'm sure it does. Actually haven't been inside of it. So, and they still have some term on the lease, Wells Fargo. So we'll deal with it, I guess, when they vacate.
Of course. And then in terms of your other comment, you said that it's not the time to develop it. Is it because of the costs associated with development?
The cost of financing, the bank's willingness to land on development, and the cost of construction, it just to really maximize the value of the site, which that site deserves. You need to go vertical, probably higher than 5 stories, ideally 7 to 12 stories, maybe 20 stories, type of project. And the construction cost, when you get about outside of a stick build and you get into a steel framing construction, which is like 6 stories and up, your construction costs really go up. And right now, economics don't make sense between what the projected rents would be on multifamily versus construction cost. I just right now it doesn't pencil, but I think if we time the market right over the next 10 years, then I think we'll be able to capture the moment in time where the rents catch up with the construction cost, where it would make sense to develop it.
Got it. It makes sense. And in terms of this overall project, you're not tying your investors to that future new development. They're only tied to this former Kmart building.
That's right. Mm-hmm.
Got it. And while you redeveloping it, are you already soliciting tenants, like people that are reaching out to you to rent the space?
Or to rent the space in
Yeah.
the
The
existing
mid-size.
box.
Yeah.
Yeah, we got 120,000 square feet box, and we got LOIs over 1 million square feet. So we got 10 times as much interest and demand to list
Wow.
here than we have available space. And so we've been actually trying to be very strategic to put the right tenants in here, and also do it in a way that tenants would have flexibility and openness to either relocate or to early buyout if we do decide to redevelop it sooner.
Of course.
So that's kind of what has been our primary selection criteria, which tenants would go with. The tenants who would be willing to either early buyout clause or relocation clause if we go with redevelopment place sooner than anticipated.
Because the redevelopment would take this building down.
Yeah.
You can build on a side from it.
We can. That's the plan, is to build in phases, maybe on an odd parcel land, build the first phase, move some tenants over there, and the space that gets freed up, demo the building and do it maybe in 2 or 3 phases.
Got
If
it.
we
Amazing.
were to tackle it, that's how we would do it.
Nice. And it sounds like this Kmart was in a busy location, right?
Yeah, it's a phenomenal site. Yeah, right of Beltline Rally. So it's a lot of people try to buy it over the years. We've been fortunate to have had an opportunity to buy it. The same owner had it since 1960s. So it's been like 60, 70 years. It hasn't changed hands. So we just every developer in town tried to buy it, and we just got it at the right time and caught them at the right time, and we're able to secure it, which was not easy. Buying a vacant big box in the current economic climate, it was very difficult to finance and to raise capital for, but somehow we managed to pull it off, and now the real work begins. It was hard to close it. It took us over 6 months, and but now even more work starts once we close it.
Right.
Yeah,
It sounds like
but
a
yeah,
very
so
heavy value lift.
yeah, so it's more of a location play, and but the fund will be focused strictly. It would follow more stricter buy box. We're not gonna do projects like this through a fund. Again, if it doesn't meet the buy box, we're gonna be very disciplined to stick with our acquisition criteria when we launch the fund.
So for the fund, you're strictly thinking of doing some sort of cosmetic renovations, not doing any heavy
Yeah,
value.
no heavy lifts. Yeah, because look, nobody has a crystal ball. I cannot tell any heavy lifts like major redevelopment is going to take you a year or 2 years, including new development um, is coming in. It's going to be, it's going to take you 2, 3, 4 years. I
Right.
cannot, think about where we were 4 years ago. We had a different president. COVID just happened. It's like so many things can change in a 4 or 5 year window. Interest rates were 3.5%, right? So we're in a total different environment. But I can reasonably predict that not a lot of change is going to happen in probably next 4 or 6 months. So I want
Sure.
to do projects where my game plan, for me to execute my game plan, I can get it done in 3 to 4 or 6 months out, because likely not a lot of things can change this quickly in a 4 to 6 months window. Projecting 4 years out, I have no idea. Maybe we're gonna be in the middle of World War III or World War IV, or so many things
Hopefully
can
not.
change.
Hopefully not.
Yeah, so yeah, I don't want to take on projects that are just because I don't have a crystal ball and I cannot tell you what's going to happen in the future, and I don't want to model my projections that we're going to be able to exit it you know, at a 7 cap or 5 cap, because what if interest rates are 12%? Then, and if the project doesn't work at that, when interest rates are 12%, then, this far out, then I'm gonna be in trouble. You know.
Very logical thinking. I like that. Thank you for sharing. So, in terms of your fund, it sounds like it's going to be more of an income play rather than being a growth.
Value add. It's gonna be gross value add, both. So we want to buy income producing properties that we can do value add through bringing mark to market trends.
Sure.
Yeah.
And you also mentioned that strategically you're going to be shifting focus from local investors to more of an institutional investors. Tell me why, and I know you said your local investors prefer the local market because they feel comfortable there, but they also feel comfortable with you. So why
Mhm.
not expand on that? You
We
already
will.
did
So there is two types of investors: retail investors and more institutional investors. The retail investors usually write checks, 100 to maybe a couple $1 million. Institutional investors, when I'm dealing with family offices, RRAs, and things like that, you have investors who write checks $5, $10 million and up. So yeah, just because of the scale at which we're looking to grow, we think it just yeah, we're probably going to have two different asset classes or share classes. One that have institutional terms. If you're writing a check for 5 million and up, then you're going to have institutional investor terms. If you're, right, if you're a retail investor writing a $250,000 check, then you have retail terms. But we're gonna have the way the fund is going to be structured. It's going to capture both, so that our existing guys and have an ability to participate as well as new institutional funding.
interesting. And will you keep it as an open-ended fund?
No, it's going to be closed end. It's going to be a series of funds. So we're probably looking to do 5 funds over the next 3 years, total of about maybe $1 billion. So we'll see how the first one goes, but the plan is to have a series of funds. Maybe do a first one at 20 million, and then second at 100, and then the other ones are maybe 300 each.
With the duration anywhere between 5 to 10 years, or
Yeah,
what?
with an option to extend, because again, if it's not the right time to sell, we don't want to be forced to sell.
Right.
But the idea is to create, and ideally if it's the right type of asset in appreciating market like Nashville, Tennessee, or Charleston or Raleigh or Charlotte, you ideally our ideal hold period is forever. People
Right.
ask me, what's your ideal hold period? It's forever. I don't ever want to sell. So the idea, and we have to consult with attorneys on this, but we would maybe refinance on the project once we create the lift and the value, refinance, pull the investors' equity out so that return the equity, but put the assets on a self-liquidating, full amortizing loans, and just keep them forever.
Amazing. I love the plan and I love the strategy. Good luck with it. It certainly sounds very, very enticing. In terms of the properties that you're planning to buy, if the properties are on modified growth, would you still consider them, or you would only want the ones that are already triple nets?
No, we would want to buy modified gross or any kind of a weird, anything other than triple net lease structure, and because that's where we make our value, converting the leases from gross to triple net. That's our entire business model. Simply convert the leases from gross to triple net. That's how we have double the value and quadruple or quintuple the equity in a short period of time.
Excellent.
Yeah, that's how we're able to deliver, I-20 IRR on average.
Very nice. Sounds great. Nikita, thank you for sharing with our audience your project plan and your future plans as well. We also like to ask our interviewees two personal questions. One of them is, how can our audience reach out to you? What is the best way to connect with you?
Email probably. Email Nikita@cityplot.com.
Nikita at
Cityplot.com, my company.
lab.com. Okay. Hopefully I typed it correctly. I put it in the chat so that
CITY.
okay. My bad, Nikita. CITY.
Mhm.
PL, the rest is correct, right?
Yes. Mhm.
Okay. Cityplat.com. Got it. Any social media handles where people can find you?
Yeah, I just changed one, and I can type it in the box, but it's
Yeah,
probably going to change again. So right now, they can find me on LinkedIn if they just type my first and last name.
LinkedIn is the best one.
Yep.
Okay.
Yep.
Okay. Sounds good. And then the second question that we like to ask is, how do you like to give back to your community or to others?
Yeah, multiple ways. I have a foundation where if you're a high school student or college student, and you're interested in the state of North Carolina, but even if you're not in the state of North Carolina, I'll still do it. And you're interested to get to real estate, I'll pay for your real estate license.
Oh, wow.
Yeah, because I started in high school, but I started by accident. There was no money, no endorsement, so I just got lucky, kind of grew my way through this business. And I think if people just are exposed to this business, and have a taste of it, they'll be hooked, and it can change their life, just like it did for me. So I want to make it easy for people to have a taste of this business. That's why, and the easiest way to get into real estate is just get your license, start doing some brokerage. So if you're a high school student or college student, I'll pay for your license just to get you in the business, and you can apply for basically for scholarship through my foundation website. It's called nikitajhitov.foundation.org. It's Nikita Zhitov Foundation for Real Estate Education. That's the name of foundation. It's a registered nonprofit.
Mhm.
So, and I do other things, we through CityPlot, we do, different nonprofit events every year, do look for hope fundraisers and things like that. Yeah, but I also set up an endowment at my old high school, which is North Carolina School of Science and Mathematics. Set up an endowment to do research in quantum physics and basically human consciousness and meditations, because I think it's where a lot of breakthroughs are going to happen over the coming decades, is in the study of human consciousness. But it's a very STEM-oriented school, so I couldn't call it just research in meditation. So that's why we call it research in quantum physics. But
Makes sense.
it's the goal is for it to be a fully funded, self-sustaining endowment. So I support different causes like this that I believe in.
Amazing, amazing. Love it. It sounds like you are big proponent of kids' education. Like myself, I am also very, very big on educating kids, ideally at home by their parents, not waiting for schools to do it, because I think it's important to have that plus the financial literacy. So love it. Nikita, thank you so much. This was a very interesting interview. Certainly the first one, I don't think we had in the past, people that jumped from residential into the triple net. So I'm sure our audience will appreciate it. And for our audience, if anyone is interested reaching out to Nikita, please use the second address that I typed in the chat. The first one is incorrect, or find him on LinkedIn. Thank you, Nikita. Bye.
Thank you. Bye bye.